Gold just did something that normally belongs in a history book, not a daily chart. In a matter of days, it plunged from roughly $5,587 an ounce to about $4,403, and then snapped back above $5,000. That is a swing of around $1,184 per ounce. Put that into scale. On a standard 100-ounce futures contract, that's a move of about $118,400. They said moves like this could never happen in a mature market. They said liquidity is deeper now. They said price discovery is clean. But when you see a market fall that hard and rebound that fast, you are not watching a tidy debate about inflation. You are watching plumbing. You are watching collateral. You are watching leverage get squeezed, not ideas getting priced. And here's the uncomfortable part. The institutions already know how this script works because they wrote the rules that decide who gets forced out when volatility spikes. Most people only see a chart and a headline. Institutions see margin tables, settlement windows, and where the weak hands are clustered. What I'm about to reveal changes the way you interpret the next 72 hours, because the biggest driver now is not sentiment. It's the mechanics of who has to sell and who has the balance sheet to buy when everyone else can't. This is time compression, not months, not weeks. The market just squeezed an entire cycle into roughly 48 hours, and it did it in a way that breaks normal expectations. Because the story most people tell about gold is simple. Dollar up, gold down, dollar down, gold up. That's the story. But the data shows something else entirely. The dollar wasn't screaming higher, yet gold still got slammed. That's the pattern interrupt, and it's the clue. Welcome to Roki Studio Markets, where we decode what matters before it becomes obvious. If you like the kind of analysis that treats markets like systems instead of stories, stay close. And if you want, drop a comment with where you're watching from, because the way gold trades in Asia hours versus New York hours is part of this puzzle. Now let's reconstruct what actually happened with forensic detail. The first clue is the contradiction. Gold sold off violently even as the dollar was not launching higher. That tells you the sell pressure was not primarily a macro dollar up, gold down trade. It was flow, it was liquidation. And the timing lines up with a set of levers that can turn a crowded position into a stampede. Margin requirements, funding stress, and the sudden repricing of safe assets when risk managers hit the brakes. One of the simplest but most powerful levers in futures markets is margin. Think of margin as the down payment you must post to control a large amount of gold. When volatility rises, exchanges can raise that down payment. When they do, traders who are leveraged have to put up more cash immediately or reduce their exposure. If you can't add cash, you sell. And selling into a falling market pushes it lower, which can trigger more margin calls, which triggers more selling. It's not an opinion, it's a mechanism. During this period, CME margin adjustments were reported, including COMEX 100 gold futures initial. Margin moving to about 9% from 8%. That may sound small, it isn't. On a highly leveraged book, a 1 percentage point increase can be the difference between surviving and getting liquidated. And when a market has just run to record highs, the open interest in the paper positioning can be enormous. That means a relatively modest rule change can create an outsized wave of forced behavior. At the same time, the narrative environment was unstable. Markets were rapidly repricing what central banks might do next, what inflation might look like next quarter, and whether growth would slow. When narratives whipsaw, risk limits tighten, portfolio managers de-risk, funds cut exposure. They do not wait for a clean signal. They react to volatility. So gold fell hard, but then it rebounded. And that rebound is the second clue. In a true fundamental collapse, rebounds tend to be weak, reluctant, and slow. In a forced liquidation event, the rebound can be sharp, because once the forced selling exhausts itself, there is suddenly no more supply at any price, and short-term sellers scramble to cover. That's why the rebound matters. It suggests the drop was less about a long-term verdict on gold and more about a short-term purge. Now, if you think this is new, it isn't. The market has done this before, and the pattern is almost always the same. In 1980, gold experienced extreme volatility around the peak that followed a decade of inflation fears. The public story was about inflation and geopolitics, but the micro story was leverage, margin, and a crowded trade that turned into a cascade. The result was not a smooth reversal. It was chaos, then a brutal reset. In 2008, gold initially sold off during the financial crisis, even though it was supposed to be the safe haven. Why? Because when everything breaks, people sell what they can, not what they want. Funds needed cash. They sold liquid assets. Gold was liquid. The result was a sharp drop, followed by a powerful rally as the crisis response shifted the monetary regime. In 2020, during the first shockwave of the pandemic market panic, gold again saw violent moves. There were moments when gold dropped as the dollar spiked and funding markets stressed. Then gold surged later as stimulus flooded the system. Again, the first move was about forced flows. The second move was about regime. The liquidation phase or the reaccumulation phase? To answer that, you have to look at the players who move without emotion. Start with central banks. 19 million ounces, that was at the end of January 2026, up about 40,000 ounces from the prior month. That isn't a day trading signal. That is a strategic choice repeated month after month. Then zoom out. World Gold Council data showed net central bank gold buying around 230 tons in the fourth quarter of 2025, up from roughly 218 tons in the third quarter. It is institutional, persistent demand. And central banks do not buy for a quick flip. They buy to diversify reserves, to reduce reliance on any single currency system, and to anchor confidence. Now, contrast that with what leveraged traders do. Leveraged traders rent exposure. They control large positions with small collateral. When collateral rules change, they are forced to adjust. That creates the kind of fast, ugly move we just saw. This is where it gets interesting. You are watching two different gold markets layered on top of each other. One is the strategic market, central banks, long-term holders, physical demand. The other is the tactical market, futures, ETFs, systematic funds, and leveraged speculators. When tactical positioning gets too stretched, the tactical layer can slam price down even while the strategic layer is still buying underneath. That's the dislocation. And now add the dollar. 7 and down about 2% on the month suggests the dollar was not screaming higher. So why did gold still fall? Because gold wasn't losing to the dollar in a clean macro fight. Gold was losing to margin calls, to volatility targeting, to risk managers who had to cut exposure across the board. The dollar didn't have to win. Liquidity did. Let me simplify that with an analogy. Imagine a crowded theater. The movie is fine. Nothing is wrong with the story on the screen. But someone shouts, "Fire," and the exits are narrow. People rush. The rush is not a judgment about the movie. It is a reaction to the exit constraint. Margin is the exit constraint. When the exchange raises the down payment, the exit gets narrower for those who can't post more cash. They run first. Their running creates the panic that forces everyone else to move. Now, look at the next 72 hours. The market is trying to answer one question. Was that drop a one-off purge or the start of a larger repricing? To get there, you watch 3 indicators that reveal the plumbing. First, dollar stability. Not direction in some grand sense, but whether the dollar keeps sliding, stabilizes, or suddenly spikes. If DXY stays soft or drifts lower, historically, that removes one headwind for gold. But if DXY snaps higher abruptly, that can reintroduce funding stress, especially if it coincides with risk-off behavior. Watch the character of the dollar move, not just the number. Second, collateral ripple effects. Margin changes do not only affect one market, they change how much cash is locked up across multiple products. When cash gets locked up, someone sells something else to raise it. That can mean selling gold, selling equities, selling other commodities. The question is whether the forced selling pressure is still running through the system, or whether it has already flushed out the weakest leverage. Third, the paper versus physical tell. When gold drops hard, does physical demand step in? You can't always see that instantly in headline data, but you can see clues. Tightening premiums, strong buying in certain trading hours, and price behavior that refuses to stay down despite negative sentiment. A fast rebound after a brutal flush is often a sign that physical and strategic demand absorbed the paper unwind. Now let's connect the dots across the institutions that matter. The exchange sets the collateral rules. The clearing members enforce them. The prime brokers watch their clients leverage and start reducing credit lines when volatility rises. Systematic funds, like trend followers and volatility targeting strategies, reduce exposure automatically when volatility spikes. ETFs transmit flows from retail and institutional allocators into the underlying market. And central banks sit outside of that whole dance, accumulating gradually regardless of the daily noise. What does coordination look like here? It rarely looks like a meeting in a room. It looks like timing. It looks like margin changes landing right as volatility is rising. It looks like funds de-risking into the same window. It looks like the market moving more than the news can justify. That's why the dislocation matters. Two markets are telling opposite stories. And the dollar is not surging, which should support gold, but gold fell anyway. Central banks are buying, which should support gold, but gold fell anyway. The only way both can be true is if the price move was driven by forced tactical flows overwhelming strategic demand temporarily, and that can't persist. Either the forced selling continues, pushing price lower until it finds a level where leverage is cleared and value buyers step in, or the forced selling exhausts and price snaps higher as the market realizes the underlying bid never left. This is the part no one is discussing. The next move is often determined by who has remaining collateral, not who has the best thesis. And so let's look at the mechanism more closely, because it explains why a 9% margin requirement matters. If you control a 100-ounce gold contract, and gold is at $5,000 an ounce, the contract represents $500,000 of exposure. If initial margin is 8%, that's $40,000 you must post. If it moves to 9%, that's $45,000. That's $5,000 more per contract. Multiply that by thousands of contracts across the market, and you are demanding tens or hundreds of millions of dollars in additional collateral immediately. Now layer in volatility-based strategies. Many fund size positions based on volatility. When volatility rises, they cut size. That selling is not discretionary. It's automatic. If a big volatility spike hits gold at the same time margin rises, the market is hit from both sides, forced selling from margin and forced selling from volatility targeting. And once the forced selling ends, the rebound can be just as impossible in the other direction, because the same strategies can flip into covering or re-entering as volatility stabilizes and price stops falling. So what does this mean forward? Historically, when gold experiences a forced liquidation while strategic demand remains present, you often see one of three paths. The conservative path is stabilization. Gold chops in a wide range with violent intraday moves, while the market rebuilds, liquidity and repositioning occurs. In this path, the dollar's behavior becomes the main short-term driver, and gold trades like a stress barometer. The moderate path is a V-shaped reclaim. Gold continues to rebound as forced sellers are exhausted, and the market reprices back toward a prior highs, not because of hype, but because the supply that caused the drop was temporary. In this path, you'll often see strength during certain hours that suggest real buyers are present. The aggressive path is a second shock. The market attempts to recover, but another wave of collateral tightening, dollar spikes, or cross-asset stress forces, another liquidation. In this path, the second dip can be fast and brutal, but it can also create the kind of base that leads to a much larger move later because it fully clears leverage. Notice what I did not say. I did not say which path will happen. The point is that the data pattern has always led to one of these regimes. And the next 72 hours are about watching which signals dominate. So what should you watch specifically? Watch whether DXY holds its recent softness or snaps higher. Watch whether gold rebounds on heavy volume or drifts upward quietly. Watch whether sell-offs are immediately bought or whether they cascade. Watch for signs that volatility is compressing rather than expanding. And watch the market's reaction to rule changes and collateral chatter, because that's where forced flows originate. Because here is the divide. Those who understand this moment are not necessarily smarter. They are simply paying attention to the right layer of reality. Most people will argue about narratives. They will argue about inflation, politics, or headlines. But the market right now is revealing something more mechanical. Liquidity constraints can override macro logic in the short term. And when that happens, the information gap becomes a wealth gap. Institutions move first because they see the mechanics. Retail moves last because retail sees only the story. By the time the story catches up, the move has already happened. If you can internalize one idea, let it be this. Price is not always a vote on value. Sometimes price is a liquidation schedule. To see how quickly pressure builds, look at positioning around obvious levels. When gold makes record highs, option strikes cluster near round numbers and dealer hedging flows concentrate there. If price slices down through those strikes, dealers may have to sell futures to stay hedged, adding momentum that has nothing to do with a new headline. Then, when price stabilizes and climbs back above those same strikes, the hedging flow can flip the other way, forcing buying. The news didn't change twice in 3 days. The positioning changed, and the hedging math demanded motion. Now add the geographic split most people ignore. Gold trades 24 hours, but it is not the same market every hour. Liquidity and motivation shift from Asia to Europe to New York. Asia hours often lean more toward physical flows and reserve diversification instincts. New York hours often lean more toward futures liquidity, macro funds, and short-term positioning. A liquidation in the most leveraged venue can drag the global benchmark down fast, even if physical buyers don't vanish. They simply wait for cleaner conditions, better pricing, and clearer settlement. The dollar side has plumbing too. The dollar index is a basket, and it can drift lower while still producing sudden spikes when global funding needs jump. Those spikes matter because gold is priced in dollars globally. A fast dollar pop can tighten conditions, trigger currency hedging, and push risk managers to cut exposure. That's how you can have a month of dollar softness and still get a short, sharp dash for cash that slams everything. Over the next 72 hours, the key question is whether the system still demands cash or whether it has already met that demand by flushing leverage. You can sense that by watching whether stress is broad or isolated. If credit spreads widen, equities drop hard, and other commodities sell together, that suggests a general cash grab. In that environment, gold can temporarily trade like a source of liquidity rather than a haven because it is something you can sell quickly. But if those markets calm while gold stays bid, that suggests the forced selling wave has largely passed, and the underlying demand is reasserting itself. Another underappreciated factor is how quickly large funds adjust risk after big moves. Many institutional portfolios run risk budgets. When volatility rises, the budget forces them to reduce positions, not because their long-term thesis changed, but because their models won't allow the same exposure under higher volatility. That selling is automatic. Then, as volatility compresses, the same models gradually rebuild exposure. This is why experts can contradict each other and still both be right. A macro view can point to dollar softness supporting gold, while a micro view can point to collateral mechanics crushing gold, and both can be true on different timelines. Think again about the 100-ounce contract. At $5,000 an ounce, one contract represents $500,000 of exposure. If price drops by $1,184 an ounce, the mark-to-market move is about $118,400 per contract. That can be far larger than the collateral posted by a leverage trader. In that case, the trader doesn't calmly decide to hold. The position gets cut. Multiply that across enough accounts and you get the waterfall. Then, when the forced sellers are gone, price can rebound rapidly because the market is suddenly short of natural sellers. So the next 72 hours are a timeline test. If the dollar remains stable to soft and gold continues to reclaim levels without fresh volatility explosions, the market is telling you the purge is fading. If the dollar snaps higher and gold stalls or dumps again, the market is telling you the cash demand isn't finished. And if both the dollar and gold rise together, that is a different signal, a broader flight into perceived safety, where both cash and metal are being accumulated at the same time. Don't watch gold like a simple commodity right now. Watch it like a stress sensor connected to collateral rules, hedging flows, and reserve behavior. Once you see that, the impossible moves stop looking random. They start looking like forced flows doing exactly what they always do until the system finds balance again. One more tell is the paper versus physical gap. After liquidation, paper prices can swing faster than real-world inventory can respond. Physical buyers often step in only when settlement looks orderly and premiums justify moving metal. If you see repeated intraday sell-offs that fail to extend and rallies that begin in hours associated with physical demand, it hints that underlying buying is absorbing paper supply. That absorption is what turns a crash into a base instead of a breakdown. And when absorption dominates, the market stops falling not because fear disappears, but because sellers run out. Gold versus the dollar in the next 72 hours is not a simple tug of war. It is a pressure system. The dollar's softness suggests one kind of environment, while margin and leverage, stress suggest another. When those collide, you get the kind of violent two-way move we just lived through. And if you're wondering why this matters beyond gold, it's because gold is often the first place. Where stress shows up when the system is repricing collateral. Gold trades at the intersection of currency, risk, and trust. When its behavior becomes abnormal, it is telling you something about the broader market's internal temperature. This is Roki Studio Markets, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether the mechanics will keep showing themselves. The question is whether you'll recognize the signals before the next move forces everyone else to.